The Financial Sense Midweek Edition with Jim Paplava. Delving in depth with authors and experts into the key economic issues.
Joining me on the program today as my special guest is Charles Oliver. He's Senior Portfolio Manager and Co-Manager of the Sprott Gold and Precious Minerals Fund. Charles, you know, one of the things that you manage a gold fund, and one of the issues I always try to point to investors is if they're going into this space, you really need to know why you own gold. And on your website, you've listed a couple pieces that our listeners can go to, reasons to own gold and reasons to own silver. And I wonder if you would discuss the most important, if you would.
There are many reasons to own both gold and silver, and I think for myself the most important thing is that they are a hedge against inflation, against the debasement of currencies. And in the last decade, we have seen significant money printing by central banks around the world, as many people have coined it, the race to the bottom. And gold is a huge move in gold is a reflection of that debasement that is currently carrying on, and I expect will carry on into the future.
You know, Charles, and it doesn't seem like they're going to stop. I mean, the ECB's balance sheet rose by almost $1 trillion last year. The Fed's rose by $500 billion. The Fed's talking about keeping interest rates at 0 to 2014, so it seems like that factor has been reinforced. I want to talk about gold equities for a moment. Since this bull market began, we've seen periods where bullion and gold stocks have risen together. We've seen other periods where either one is outperforming the other. We've been in one of those periods recently for the precious metal stocks where stocks have underperformed bullion in 2011, and it looks like again this year, unless you own, let's say, for example, GDXJ. In your opinion, what accounts for this?
There are two factors at work. The first factor has to do with the ETF, and one of the things is if you look at before the launch of the exchange-traded gold bullion funds, the period around 2000 to 2004, gold equities actually outperformed gold bullion, and this is measured with the HUI index, by a factor of 4 to 1. So in the case of the HUI, it was up about 425% over those 4 years, while the gold price was up 61%. However, since the launch of the ETF, what we've seen is a lot of investors have been flowing money into gold bullion and at the expense of gold stocks. So while we've seen the gold price going up, we've actually seen a period of time where gold stocks in general have been coming down in value. And one of the ways you can actually measure that is if you look at a lot of the big cap companies that have been around for a long period of time, back in the earlier part of this decade, they were trading at 30, 40, 50 times PEs, whereas today you see those companies trading at 15 times PE, 9 times PE. They are trading at the cheapest PE valuations they have, except for a short period in 2008 for the entire decade. The other factor that occurred in 2011 is basically 2011 felt a bit like 2008. And in 2008, gold stocks were acting like stocks first and gold stocks second. And during those periods of time, and they're usually short periods of time, but during those periods of time, you do see that the gold stocks will underperform. And 2008, gold stocks were down about 30%, while the price of gold was up marginally. And in the case of 2011, we again saw the gold stocks down. And again, I believe that was in sympathy with the weakness in the overall stock market.
These periods, and I've seen 5 of them. We had a period of 2002, 2003, mid-2003 to 2005, 2006, 2007, 2009 to 10, and then 2011 to the present. Yet, as you pointed out, if I go back to when this bull market began, The HUI was at 35. Today it's at roughly 514. That's up 14-fold.
Right.
Bullion was at 253. It's at 1725. It's up 6-fold. So even with the advent of the ETFs, the stocks are still up 14-fold versus 6, almost 2.5 times the difference.
Yeah, over the long term, gold stocks will outperform on the upside. Having said that, I mean, if the gold price is going down, they will probably underperform on the downside. So, but having said that, my own personal view is very bullish on the current future price for gold, as I continue to believe in debasement. So I think having stocks make an awful lot of sense at this time, especially because of the cheapness that they currently offer in the market.
Yeah, I'm just looking at a Bloomberg screen of the large gold miners. In addition to carrying or sporting low PEs, I mean, Newmont has a PE of 12, Freeport 8, Barrick has a PE of a little over 10. But something else that's new, Charles, and maybe we can talk about this, is you're getting a good-sized dividend. I can look at, for example, Freeport right now, a dividend yield of 2.9. I look at Newmont, 2.3. I mean, that's better than what I can get in a 10-year Treasury note.
Yeah, no, absolutely. One of the things that's really happened, probably I'd say the last 2 years, has been that a lot of these companies that, you know, back at $700 gold, they were making $200 in margin on their gold ounces. Today, they're making $1,000 of margin, and they are sort of creating large amounts of cash flow. And a lot of this money is starting to come back in the form of dividends. We've seen a lot of companies institute dividend policies that didn't pay it previously, and we've also seen the companies such as Barrick and the Newmonts increasing their dividends several times over the last few instances. And in the case of Newmont, I'd also add that they have come out with a new dividend policy where they are actually going to pay a dividend that's going to be linked to the gold price, which the market has been very enthusiastic about.
As a fund manager, when you look at choosing a mining equity for your portfolio, what is the most important attribute that you look at? There's
no one single attribute. There's a whole bunch of them that come together. If I had to pick two, what I would say is the management team and the assets themselves. And I've seen lots of good assets that are poorly run by the management team. So you do want an industrious entrepreneurial group, preferably with skin in the game. And I'm not just talking options. I like seeing management that have actually bought into the company and paid cash. And then the other thing is the asset itself. I've given you two things. The other thing that I should mention is, location. Location is very important because there are certain countries where you can have a great asset, but the government is on the take and is not going to make it very economic. So many different things that sort of go into looking at a good gold company.
What about the aspect of shareholder dilution? That applies to the big companies as well as even to the smaller ones. What are your views on dilution?
Nobody likes dilution. The shareholder, my biggest concern usually comes with the small cap companies, generally those ones that don't have production and cash flow and ultimately do have to come to the market to help finance the development of their ore resource. It is unfortunately a necessary evil because if you don't take it, you will not move forward, you will not add value. One of the things that in talking with a lot of companies, I like to sort of give them some of the expertise that I've built up over the years into how to manage that dilution, how best to move forward. And sometimes you have to take baby steps and show that you have an economic resource that will be viable and do it slowly. And sometimes you have to do a little bit more. It's always a concern. In the case of the large caps, they often don't need to finance, especially at today's prices. A lot of them making significant money. I guess one of the concerns that I have with large caps is it does become tougher to grow, and often large cap companies do sort of end up making mergers and acquisitions of smaller companies. And when I look at that, ultimately, I hope that management will have the foresight to do an accretive acquisition And that's something that I think is very important.
You know, Charles, as I look at this space today, if I was a large miner like a Newmont, obviously I have geologists on staff, I have an exploration budget, I can go out and try to go drill a hole and try to make a new discovery, but it seems to me it might be much cheaper to buy an existing project, let's say a late-stage development play that has gold in the ground. It seems like gold in the ground is cheap.
Yeah, absolutely. I think one of the models that a lot of the large companies have moved towards is actually sort of downsizing their exploration staff. Placer Dome is probably the classic example. They used to have 250 employees, and in the early part of the last decade, they sort of got rid of almost all of them because large companies, for whatever reason, do not seem the most efficient at doing exploration. And often what you find is that the smaller companies with the entrepreneurs have done a very good job of spending dollars wisely and conservatively. And hence, today, in a lot of cases, it does make a lot more sense for the majors to be looking at buying an intermediate gold company with a development project. And, you know, especially today with the valuations where they are, I think it makes an awful lot of sense. And I do believe that the large caps will actually sort of do a significant amount of M&A going forward.
Your organization, Charles, has been known as being bullish on the resource sector, and you did so early, going back to the early part of the last decade. You've also been very helpful in financing a lot of successful exploration and development companies. When you look at a junior, we talked about looking at large companies, the management team, and you mentioned the asset itself and location. Would all three of those apply likewise to, let's say, a late-stage development play?
Absolutely. I mean, I think that no matter what size company you're looking at, you want to know that the management is capable of doing what the job is required. You want to make sure that they have the quality assets that will produce an economic return through development, and you also want to make sure that they are within a jurisdiction where the government is not going to take all the benefits of the mine that ultimately comes into production.